Welcome to Realcast, the weekly roundup of the real asset markets. My name's Richard Betts and I'm joined by Dan Innes, Paul Strome, and this week by Jace Tyrrell, Chief Executive Officer of the new West End company. Jace, really pleased to have you with us. You were one of our headlines of the week as London's West End bounces back with $5 billion of investment. So interesting just to get your take on that.
Yes, a remarkable week. $5 billion of capital investment announced this week. About 20 or so schemes around the Oxford Street district, the core West End. And I think given what's happening in retail real estate and around the world in the big global cities, this is a real remarkable commitment of confidence in the medium to longer term. And what was quite interesting with $5 billion of development that's been announced is actually a lot of mixed-use schemes. So moving the nation's high street beyond retail to leisure, to hospitality, to the overused word perhaps of experiential. And I think they're looking, a lot of these developers and owners of real estate in the West End are on the Elizabeth line opportunity. The planning policy is in place now. So I think the future, medium to long term, is looking really bright for this bit of London. But obviously we need to trade out the next couple of years until we get to that medium term position.
And Jace, how important is the infrastructure side to that?
Critical, because I think, you can have the capital investment from these owners and developers and businesses. You can have the policy, which is actually very much in favour of this mixed-use repurposing structural change that's happening. But we also need access for our customers, for our employees. 2/3 of Oxford Street is offices, above the retail and the leisure. So Elizabeth Line is a fantastic opportunity to connect us to let's face it, a workforce that's going to be 3 days a week. So actually coming in from Reading to Bond Street in 45 minutes and having your office in W1, there's going to be an opportunity there. But also the leisure market, having Crossrail again, will perhaps enlarge our catchment to a wider cohort of leisure visitors as well. So critical, it couldn't come at a better time actually. 4 years delayed. $3 billion over cost, but actually the timing for 2022 is really important for the West End's next decade ahead.
Thanks very much, Jace. It's been interesting, actually, that in both the events I was at in Frankfurt and Lisbon, retail was a positive focus of discussion. And so good to see this as a growing trend both in London, but also across Europe. Dan, what have you been watching?
Well, I've been following a little bit of resi and the retail themes that you mentioned, Richard. I mean, in the resi world, the guys at Moda Living, they've made another debut into the co-living sector with a promise of a £1 billion pipeline of new sites. And they've secured several in London, 6 to be exact, and that could accommodate about 2,500 or just over 2,500 rental units for shared living, and several more sites in negotiation already. And they could start as early as next year with the aim to develop around 1,000 co-living homes every year to take advantage of that kind of rental revolution that's happening in the UK, something that we're more familiar with in countries like Germany. Elsewhere and back into the offices and retail market, the owners of the Debenhams flagship on Oxford Street, something that Jace will hold close to his heart. The owners are Ramsbury, and they've been given planning permission by Westminster Council for a major office revamp. The council has welcomed the proposals, in particular the investment into Oxford Street, and gave unanimous approval to that project. And that's going to extend the existing office floor space up to 377,000 square feet. And that's up from only 88,000 square feet. And it's, of course, going to shrink the retail provision to just 72,000 square feet. And that's down from 273,000 square feet back in its heyday. But that's one of the many projects that Jace is referring to in this major push in the West End of London. And that was also lauded at the London Real Estate Forum event that was held at the Barbican last Thursday. The head of LREF, Nick McKeough, he was pretty delighted actually with the turnout, which almost reached pre-pandemic levels. And there were some somber headlines in the news. And fashion operator Next has said it's going to close 13 of its UK stores. And that's despite an annual profit of around £800 million. And it really just said that most of those stores that were going to close were in locations that it couldn't even achieve any of its target margins on any terms. They did mention that most of their stores are going to move to turnover rents, with 28 of the leases it expects to agree this year linked to store turnover, and 15 of those to be total occupancy cost deals. But that was a big theme at retail industry events events this week, and that, of course, included Completely Retail Marketplace, which took place at the beginning of the week. There were this and other signs, that kind of pointed to why fewer retailers are paying their rent on time as well, which also came into conversation. There was an article in the Times last week that said that was prepared by the team at Released, and they said that only 11% of the rent due from retailers was paid by last Wednesday's quartered rent day. And that compares to 14% in the previous quarter rent day in June. And before the pandemic, it was normal for landlords to receive around 30% of rent on the quarter day. Elsewhere, sometimes the headlines just write themselves, Richard, and Lego's move into bricks and mortar retail is really paying off. Lego opened more than 60 new Lego branded stores in the first half of 2021, and that brings their total number of stores to 737. So the brick brand kind of cemented its role as the world's largest toy maker and increased its revenue in the first half of this year by 43% year on year, which is $3.6 billion and a net profit of $570 million. And it's also planning to open more and more stores.
Good to see brands like Lego expanding and growing their footprint in physical stores. You mentioned LREF and Completely Retail, and it was good to be back hearing the views in Lisbon and Frankfurt, which was our first hybrid event, especially the reaction to the recent elections in Germany. The view seemed largely positive, with speakers in general seeing the three-party coalition requiring consensus government, but also a view that after 16 years of Angela Merkel, it was good to see a change and that might provide some positive momentum also. As you'd expect, the view was very positive on logistics, office, and also residential. Paul, what was your pick of the headlines this week?
Well, in particular, residential in Germany, notably when Sweden's Heimstaden Bostad, a specialist housing investor, announced that it is to pay Germany's Achilles about 9.1 billion euros for a housing portfolio spread across Germany, Sweden and Denmark. Obviously, it's a huge deal. The portfolio comprises 599 buildings, that's nearly 29,000 homes, which produce an annual rent of 2.8 billion Swedish krona, which is about 276 million euros a year. Heimstaden is financing the deal with a mix of cash, new equity and bridge financing, and equity is coming from, among others, Swedish pension funds, KPA Pension and Electa, and the Swedish Pensions Agency. This is not the first recent deal of scale by Heimstaden, although the largest for some time. Last December, it announced a 1.63 billion euro acquisition from private equity firm Niam in what was Denmark's largest real estate transaction ever. In January 2020, the 1.3 billion acquisition of a resi portfolio in Czech Republic made it one of the largest private property owners in that country. Also in Germany, the investment and asset manager Domicil Real Estate Group acquired the so-called Now portfolio from Swiss Life Asset Management. The portfolio, we don't know how much they pay for it, but in a normal week, it would have been a very large deal too, and comprises 86 residential buildings in 20 locations in 7 clusters in major cities throughout Germany. And that includes 2,389 residential units. And then we heard that Norway's largest pension company, KLP, and a group of 8 German pension funds and insurers have made commitments of 270 million euros to the Catella European Residential 3 Fund. The new capital has increased the fund's total equity to 750 million since its launch 2 years ago. The latest capital raise follows the fund's transition from being a light green property fund to becoming the first pan-European dark green residential property impact fund under Article 9 of the EU Sustainable Finance Disclosure Regulation. This new darker green status apparently means that the vehicle pursues sustainable societal objectives or the reduction of carbon emissions in its investments. The fund's managed by Berlin-headquartered Catella Residential Investment Management, whose managing director, Michael Fink, also said that the fund has been structured around Professor of Risk Engineering Nassim Taleb's anti-fragile investing concepts, which are designed to safeguard against black swan events, such as global financial crisis or COVID-19.
Yes, that's interesting on the residential side. And I also did an interview with Samantha Kemp, Chief Investment Officer at Immo Capital, looking at single-family residences and the fact that new technology is coming through to potentially open that up to institutions institutional investment markets. And that'll be an interesting one to track as well. Also on that ESG side, that was very much a dominant feature coming through both in Frankfurt and Lisbon. And of course, will be a key topic at Expo Real, where we'll also be launching Impact Magazine. Thank you, Dan and Paul. Thank you, Jace. Great to have you as a guest on Realcast this week. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the week in real assets.